Whether we are at the market top or not is the most hot topic of discussions now. On one hand, we are seeing market cap to GDP ratio rise to record levels, which is even higher than the 2007 top. We are also seeing more than 500 companies which are trading at a price to earning multiple of more than 100. We are seeing unprecedented gains made by retail investors and, of course, the large investors through SME IPOs. We are also seeing high valuations of companies compared to their global peers. To give a few figures, market cap as a percentage of GDP is close to 200 in US and close to 140 in India. This was 120, around 120 in 2007. Today it's 140. The global average for this currently is around 60. And there are 550 plus companies quoting at more than 100 price earning multiple, and around 500 plus companies quoting at a price to book, which is 10 times or more. This is all in the listed space. All this leads us to believe that we may very well be at the market top or at the fag end of the rally. However, there is a different perspective which says that the market might not have yet exactly topped out. At the moment, the main reason for the contra opinion is sheer liquidity available with retail domestic institutions and foreign institutional investors. The SIP book of 26,000 crore per month, fueled by the retail investors, has gradually created a corpus of around 4 lakh crores of cash with the domestic institutional investors who are waiting for a fall for the stocks to reach the right valuation so that they can buy. Now, where did this 4 lakh crore accumulate? It just got accumulated because of a reduced vigor of investment from the fund manager's side, less investment ideas available, and at the same time, increasing flows of SIPs. There is an unprecedented liquidity which is waiting to be invested in. And of course, we can assume that this will not let the market fall down to a large extent. Now, another point. Because of this, the previous corrections have been shallow and the recovery has been fast. Now, on top of this, there are FIIs, foreign investors, who are waiting on the sidelines with tons of cash in hand. It cannot, I mean, it's so large that it cannot be, totaled, but it's north of tens and 20 billions of dollars. They are waiting for a meaningful correction so that they can enter at the valuations which are comfortable to them. All this put together, there is enough liquidity in the market to see the stock prices again on the upwards, should there be a meaningful correction. So what do we do with all this data? Answer is simple: keep invested. We in our PMS have always been invested since the last year. I mean, even today we are 100% invested, which is the reason for our returns. We are invested at reasonable valuations, and we are okay and prepared to lose 20 or 25% of the gains and be prepared for volatility in the portfolio. One thing is for sure: if you're invested in good companies and quality stocks, even if the prices come down in a correction, which cannot be timed by anyone, they will surely come up and regain the previous highs, although it might take some time.